Good morning. It's a Monday, 7:59 a.m. Pacific Standard Time. The date is 1/18/2016 in the United States, Martin Luther King birthday. So, here I have a daily chart on the S&P 500. One of the things that I'm going to emphasize about the month of January is that within this monthly time frame as of current date is that it's the biggest sell down in US history in the short time that we have had in these markets. So basically what we're dealing with is an overbought market for 7 straight years. We said that these markets were going to come down. Short term, we are oversold. We're going into a major earnings season that is starting right now. And when I say right now, I mean now. When I talk about the earnings season that's starting tomorrow morning on January 19th, this is before pre market, this is after hours market. That means that publicly traded companies in the US, Goldman Sachs, so this is what an earnings season looks like, and we're going to be full bore to the throttle in company quarterly reports that is going to come out, which is going to also create an extreme volatility. So on the S&P 500, like I said, this triple bottom, referring to this last low, we undercut these other lows here where we had rallies that had only given up the moves. Just remember one thing though, that these double bottoms here were in calendar 215. Now, having said that, on a daily, I'm going to be moving right over to a weekly chart of the S&P 500. The S&P 500 is sitting on its deathbed. It's got a weekly sell signal. It's got a calendar 2000 weekly. This weekly right here is one of the biggest weekly reversals to start out in the month of January. And basically, the weekly chart does not lie. Now, we can argue the fact that we are oversold within the price cycle. And oversold just means that in the short term, we have had such a downside move is that markets bounce. What do I mean? They go up in volatility before they roll over and they make another lower low. This was a low that was done back in year calendar 214. That's this lower trend line. This green line that I want people to understand what that is, that's a major what? 200 weekly simple moving average. Where is that weekly moving average? 1780. Now that we have said all of this, this is a very weak start to a calendar year that we have seen in the last 7 years. So, listen, the algorithms and high frequency has taken to these markets to absurd levels up here where they were extremely overbought. And this is what happens with the weekly sell down. Now that I've said that, let's do the following. Now we have a monthly chart. This is your 2016. This is where we ended in December. However, when you take a look at this monthly sell down, which is coming all the way back over here, right over here, let's take the low of this trend line. Let's go all the way back over here to calendar 2014. In 2014 in January, we had a good sell down, but we continued to go higher. This trend line right here that's coming across, this diagonal line where my pointer is a huge support for this monthly chart. Now, having said that, the blue line is a 10-month moving simple average, which is a significant moving average because it's done on a monthly level. And what we're going to do is, once again, we're going to go up here and we're going to scroll down. And what we're going to do is we're going to talk about what this monthly moving average really represents. And so 2033 is the 10 months, and the red line is a 20-month significant moving average at 2025. And we're starting the earnings season. Part of the U.S. markets are officially, in our view, bear market. And the bear market is upon us in certain areas of the U.S. economy. And the U.S. economy has to deal with corporately held profits that are being released tomorrow. And I'm just going to blow this up, and nothing goes straight down. That means that when we come up from an oversold, we're oversold down here. And oversold means that any up move back into lower resistances in key indexes is that we will roll over and make another new low. Nothing goes straight down forever, but I will tell you, in our yearly format in calendar 2016, at some point between now and the end of the month, we will be writing our yearly formulas with indexes that will not change. So the bear and recessionary. So we're in a recessionary environment. And why am I saying that? Well, I can tell you why I'm saying that. The U.S. manufacturing is in recession. Some of the calendar earnings that are coming out in different sectors that we're starting tomorrow are recessionary territory. And therefore, one of the biggest pump and dumps in the United States history has taken place since March of 2009. And they did. And there is a price to pay for irrational exuberance. And the exuberance is that this economy here in the United States, we don't have a perfect economy. We're so far from that it's pathetic. And the fact that we're still up here, this is still part of an overbought top, multi-monthly level. You couldn't break it higher, and you're not going to in this calendar 2016. And here's why. We would like to point out the fact that 1 year ago, before January 15 started, um, I said that we were in a super bubble in the year 2015 and 2016. And the timestamp on this, we did several. This was the last one that was done on March 5th, but we also had one that we did in January. And we are going down. And that the data, the timestamps, the analysis, the accuracy, we've got 100 different checklists saying that we're right. And now that we have reached calendar 2016, this is going to be the beginning of a new bear cycle. And certain things have already calculated mathematically that we are in that environment right now on this monthly chart. And one thing that I'm going to say is this blue line that you see on the chart right here. This one right here is a 40-month moving average, this line, and we're coming to it now. Let's take a look at 1750 on the S&P, and that S&P 50-month moving average is at 1751. So as we're doing this analysis here today, is, once again, we're not going to be right. They have brought it down very hard. It's the worst January in a short term reversal. It's the worst one ever. And yes, it is. Now, when we take a look, also the S&P closed at 1880, down at the close of 41 handles. The other monthly indexes, we'll talk to them when we get to them. And when I declare a reversal in these markets, I haven't missed one yet. I never missed the one in year 2000. I never missed the one in year 2008. And I am not missing this one year either. And the it's just the beginning of it. So, in the calendar economic reports that are going to be released is that publicly traded corporations are in a bear move, meaning that a bear move means is that in the last quarter of these earnings in October is what we call certain sectors of the economy are, in my view, and I haven't missed one yet of my views, the bull is getting taken down, and we've undercut these major monthly levels. Now, earnings season. We will be taking a look at the companies in pre-market and aftermarket. But what we're looking for in our calculations is how in depth may it be in the S&P cash 500 is parts of it is in recession. And we're going to conclude it that we are not wrong about January. We told everybody over here before January ever started that you were going to see a significant sell down in these markets. And that's exactly what you got in all time frames.